Welcome to another episode of Invest Iowa. Today, we have the most boring topic of all times, lending,
Amen to that.
financial institutions. No, just kidding. Okay, we do have the topic of mortgages and financial institutions, but we don't necessarily think it's boring. That's why we're having this conversation. Today, I have Tyler,
Hi.
to which I am so happy to be here because the amount of knowledge that I'm gonna get from you today, man. I am a living vacuum of knowledge.
There you go.
Ready to ask you a bunch of questions. Give me a quick introduction of how do you become to be who you are.
Oh, me? Well, there's this guy and gal. They got together one night. No. Gosh, I started in lending 10 plus years ago, straight out of college with Wells Fargo, slinging mortgages. Did that for 7 years. Moved to a smaller bank where I'm currently at, a small community lender, Union State Bank. And with them, I wear many hats. I do anything from auto loans to residential lending to commercial lending. So, yeah, do a lot. So happy to be here. Hope to be able to drop some knowledge bombs on you guys and help out with anyone who's got questions or curious about the lending aspect of buying homes or real estate.
So we will leave in the description all the contact information for Tyler because, as usual, once you're done watching the video, you're probably gonna have more questions. If you don't, then you weren't paying attention. Let's start with the basics. How do you get yourself involved into the lending world?
Get involved from a buyer standpoint or myself? How did I get involved?
Right. So what do you go to school for?
I went to school at Iowa State for business.
For business.
Yes.
Okay. When does it cross your mind that you wanted to go into like banking and lending and financial institutions?
That's a good question. Getting out of college, I didn't know really what I wanted to do. Had a friend's older brother who was a manager at Wells Fargo who was hiring. So they recruited me at that point. I didn't know much about mortgages. I knew kind of what they were as far as you needed it to buy a house, or so I thought, unless you had cash. So I went into it kind of blind and figured out I was pretty good at it. So I stuck with it, and here we are now.
How long have you been doing that for?
10 plus years.
Wow. So you
Going
were
on 11, so yeah.
Did you okay, you were there a couple of years after the financial crisis in 2008. Were you at all involved into that crisis?
No, I kind of came on board as things were kind of on the up and up. So rates came down again, so it was kind of a frenzy of people buying and refinancing, so the phones were just ringing off the hook when I joined. So I got my first taste of it being a chaotic environment, and then since then it had, I mean, the lending industry is kind of like a wave or a roller coaster. You got ups and downs. So there were some slow periods in there where you kind of catch your breath, and then you might have interest rates come down and you have a rally again, and you're just going crazy. So it's that's what kind of makes it fun, is there's fast-paced environments and slow-paced environments. There's different types of lending. So what I do now is a little bit of everything. So I get to see different borrowers from different parts of their life. They might be buying their first home. They might be buying their 10th home. They might be a real estate investor who's got a portfolio of 30 homes, or buying a multifamily or a commercial building, or retail real estate. So I kind of get different aspects of it, and it's a lot of fun. That makes it more fun.
What's your job position? What's the job description?
My job description is Assistant Vice President and Mortgage Loan Officer.
Mortgage loan officer.
Yes.
So what does a mortgage loan officer do?
Mortgages. No, we it's consulting up front. So we of course walk our clients and customers through the process, figuring out what they qualify for on the residential side. Commercial side, again, same aspect. Is this deal something we can work with from a cash flow standpoint, from a borrower standpoint? So we consult with them and also kind of put the loans together. We pair them with the best products, interest rate programs, just to kind of put them in the best financial position they can be in. And that what also works for the bank as far as lending standpoint. So,
Okay. Um, for somebody who is new into this world, as a first-time home buyer, what do I go to a lender for?
to help, obviously, to get the answers from the financial side of it. So if you're buying a house, there's going to be a lot of people in your corner helping you out. Your lender with the financing aspect, your realtors can be helping you out with, find the properties, answering your questions, and guiding you through that process to when you have the keys in your hand. So there's also other people involved on the back end. You have transaction coordinators, escrow companies, title, abstract, things like that. You have insurance. So a lot of people in your corner trying to get you from when you first start thinking about buying a house to actually closing the deal, getting the hand or the keys in your hand and moving in. So lenders, loan officers, what we do again is we listen. They should be listening to the client, finding out what their needs are, and pairing them with the best loan product that's going to get them to the house of their dreams.
How do you describe, well, I guess let's go into that in a later moment in this interview. What are some fun facts that you know people don't know about lenders?
Ooh, fun facts. We're not boring. Yeah, look at that. No, I don't know. Get to know your lender because they have probably a lot of knowledge. They've obviously helped a lot of people. So that's one thing. People just they try to get the best interest rate or something like that when trying to buy a house, but that's not always what it's all about. You want to make sure you have somebody who's there for your best interest and is going to be there 6 months from now, a year from now, to answer any questions you have. So I think from getting to know your lender is a good part of the home buying process. But outside of that, I mean, yeah, we tend to have a wealth of knowledge. So if you have any questions about real estate, go to your lender. They might know the answers you're looking for. They might know people that can answer the questions that they can't answer.
Okay, now I'm going to ask you a question I wanted to ask you before.
Yeah.
How do banking institutions work? How are banks able to provide these products?
Good question. So through internal ways, they have portfolio loans that they can offer. That's where they are funding the loans themselves. So that's based off of different variables, deposits, things like that within the bank. And then there's also the secondary market, which is what most people are familiar with. So you have your conventional financing, your FHA, VA, USDA loans, your rural lending. Those are all offered through typically the secondary market. So it's investors like Fannie Mae, Ginnie Mae, Freddie Mac, Federal Home Loan Bank that offer loan programs through lenders. So the lender will initiate the loan, close it, and get sold to this investor on the back end. The lender may still service the loan, so your payments, customer service, everything is still through that lender. It's just on the back end that loan is sold to a secondary market investor.
Okay, I think that's one of the components to lending that a lot of people get confused, and I think myself I'm getting confused with this.
Yeah.
So to put it in perspective, you get a loan, like a loan approval. Let's say you buy a house, right? Why does the bank sell it to another institution, to a secondary market?
Good question. There's several reasons, but main reason is to not have to hold the loan on the book because they have to have a certain amount of capital assets of their own to be able to hold these loans all internally. So that gets it basically off their books, as well as the risk goes from lender to that investor. So they no longer have the risk of that loan. They still have to service it, but if anything were to happen to that loan, it would fall back to the secondary market investor in that case. So from a risk and capital standpoint, those are pretty good reasons.
Are there any loans that stay in house?
Yeah, yep.
What's the difference between those two?
Portfolio and secondary market is kind of the lingo there, but the portfolio loans are the home loans or the loans that stay in house. That could be auto loan, personal loans, portfolio loans for residential lending, commercial lending, things like that would be retained by the actual lender. So that's where you're going to get different rates. You're not going to get a secondary market lower fixed, long-term fixed interest rates. You're going to get probably higher rates and riskier, I shouldn't say riskier, different terms than you would on a secondary market. So for example, on a residential loan, you might get a 5-year balloon or 5-year variable rate at a higher rate to qualify for a portfolio loan versus the secondary market, you might get a lower rate on a 30-year fixed. So it's portfolio loans and commercial lending. It's just, different terms, different rates.
A lot of terms.
Yeah.
Describe to me what is a balloon?
Balloon payment is where at the end of the agreed upon balloon term, it balloons. So the remaining balance of that loan will be due.
Who will benefit from that?
Both parties do in a sense.
So why would I get a balloon payment?
That's a good question. Sometimes that's all that's offered for the term. So some customers might not qualify for a secondary market loan, and the lender is willing to lend, but on their terms. So they need to make it a term that is possibly less risk for them.
Yeah.
So it's kind of like if you buy a house on contract, it may balloon after a certain number of years. The reason behind that is they're wanting to not carry that note for a long-term period. It alleviates the risk. So at that balloon period, either refinance with that lender or with somebody else, possibly into a secondary market loan, something that has better terms and interest rates for the client at that time. So it allows them to have a loan product to buy a house or something now versus waiting to be able to qualify for something later.
Wow. Okay, so for example, if I didn't have the qualifications to buy my dream property, I could get another property with a balloon payment and then finance it with another property I already have?
Possibly.
With a balloon payment?
With portfolio lending, commercial lending, another thing with the terms is the down payments are going to be higher. So that's where it's portfolio lending is more of a lot of times if you can't qualify for the secondary market, it might not be the borrower, it might be the property itself. It might be a non-conforming property like a barn style house or something like that wouldn't qualify for the secondary market. So it's not just the borrower may not qualify based on income or credit. It could be the property itself, where it's located, things like that. So, but essentially, you might have a higher down payment up front. I'm forgetting what the actual question was now. I just rambled there. But essentially, there's different reasons why one might do a portfolio loan or, like that's set up on a term of a balloon, or it might be a 5-year variable rate where it's fixed for 5 years and it adjusts. There's different reasons that aren't just credit or asset or income driven.
There are multiple lenders. What makes a lender stand out?
Customer service. The loan officers being helpful, being there to answer questions. So some lenders are going to be very transactional. They do high volume. They just want to get the applications in and get through them as many as possible, whereas others are lower volume, more customer service centric and want to help people. So that's how I stand out. I don't do 100 loans a year, but I do enough where I can still give the best customer service and keep people happy and keep them coming back.
In terms of products, how do they vary?
It's a good question. So
I'm getting good questions today.
Good
Let's
questions,
go.
tons of 'em.
I told you.
Yeah, I mean, depends on the loan type. So we'll touch base on like your residential lending.
Okay, let's talk
So,
about residential. That is like
residential.
most first-time home buyers.
Yeah,
that
first-time home
have no
buyers, or
idea
you're
about
buying
this.
your 10th home. It's like your primary financing, the home you're going to be living in. So, again, secondary market loans is going to vary by lenders what they offer, but you could have just a straight, more traditional, conventional loan. With that, first-time home buyers, they can put as low as 3% down. To get out of paying private mortgage insurance, you're going to want to put at least 20% down. There are some lenders that have piggyback loans to try to get you to that 20% LTV, but you have a second mortgage. So there's different ways you can structure that. The terms on those, usually 30-year fixed rates, 15, 20-year fixed rates. They have ARM products out there, so you have...
I have 3 questions before you continue.
Yeah, go for it.
Okay, first, why is 20% the sweet spot in order to not have to get private mortgage insurance?
That is what the investors, again, kind of set that bar at. So that's where they believe that the risk tolerance is low enough where they don't have to require that private mortgage insurance on it or mortgage insurance.
Okay,
So,
20%.
Yep.
And then the loan to value will be 80%.
Yep.
Okay.
So, and there are some like, again, in-house portfolio loans where it might be 85% loan to value for that threshold, or even 10% I've seen. So it's going to vary. Talk to your lender, your loan officer, and figure out what's available.
Second question, how do you define private mortgage insurance? Who gets it? Why do they get it? Well, I guess we already answered that question, but
Yep.
what is so special about private mortgage insurance?
Private mortgage insurance, or mortgage insurance in general, protects the investor in case the borrower defaults on the loan. So it's a
The
insurance.
borrower, meaning the bank, the financial
Yeah,
institution.
it could be the Freddie Mac, Fannie Mae investor, Federal Home Loan Bank. Could be the bank if they're holding it on their books, but it provides insurance for the carrier of that note in case the borrower defaults. So it does not benefit really the borrower in any way. So if you can find a loan product or save enough to put down the 20% or whatever is required by your lender to not have that private mortgage insurance, that would be beneficial. Otherwise, you're basically just throwing money away each month. Now, there are benefits, or there are loan programs that can be beneficial as far as, if you don't have a lot of money and you want to put less down, like 3%, and carry that PMI, you can later on possibly refinance out of it, or as homes appreciate, possibly drop that private mortgage insurance off sooner as well. So all good question to ask your lender as far as, when does this PMI or mortgage insurance drop off? Are there ways that I can get rid of it sooner? So there are loan products like the VA loan that does not have mortgage insurance. They treat it a different way. They have an upfront VA funding fee where they kind of collect it's not mortgage insurance, but a fee up front to kind of guarantee the loan. Trying to think of any others.
Well, while you're thinking some of those, I guess my third question was, explain to me what ARM loans are.
Yeah, so adjustable rate mortgages is...
Adjustable rate
Yep.
mortgage.
ARM. So opposite of a fixed rate. It's got a fixed rate period, but then it adjusts after that. So a common ARM product would be like a 5-1 ARM. So 5-1, the first number is the fixed period, and then after that is the adjustment period. So it's fixed for 5 years, and then it'll adjust every year after that. So right now, they're coming back, and they actually have come back. I shouldn't say they are coming back, but they've come back as far as they are offering lower rates on ARMs than your typical 30-year fixed rate mortgage right now. So when it comes to an affordability standpoint, a lot of people are choosing those ARMs to secure a lower interest rate up front to be able to possibly afford a little bit higher of a home just due to home prices going up. So the risk there is in 5 years or whatever that adjustment period, when it comes to begins, we don't know what rates are going to be there. So there's risk there that it could be, depending on your ARM product, whether it's 3, 5, 7, 10 years, rates might be higher in the future.
For the buyer.
Yeah, yep.
It's a
So they
risk
can
for the
adjust
buyer.
up. A lot of them can adjust down too. So you could be playing your cards right in that sense. But yeah, I mean, always think of budgeting for that in your future.
Does the bank determine how much does the interest rate that they're going to charge on the ARM mortgage vary?
Yep.
So
Yep.
let's
So again, could be bank by bank, or secondary market investor has their basically rate matrix, pricing matrix, you would call it, as far as what rates the lender needs to charge. There could be different variables that go into the down or loan to value, credit score, different things like that can differentiate what rate is offered to a borrower.
so that loan is not that common. Who could benefit from it?
Anyone, especially in this market with high home prices still. As rates go up, it lessens the affordability. So think of it as someone trying to buy a $250,000 home a year ago when rates were lower might only be able to afford a $200,000 home now because rates have gone up. Well, if they take a lower interest rate on a 5-1 ARM than what a 30-year fixed rate is, all of a sudden that $200,000 maybe is a $220,000 or $230,000. So it gives them more flexibility in what they may be able to afford at this time. So that's why people are mostly choosing ARMs right now, in my opinion, is to be able to afford more house.
But
It gives them that ability.
wouldn't you consider that gambling? Because you don't know
It
what
is.
the future is.
Yeah, they are riskier products. Yeah, I will say that. I mean, they're good products. They have floors and ceilings on the adjustment. So, for an example, say you have a 5-1 ARM. On that first adjustment, there might be a 1% ceiling on as how high that rate can adjust up to.
Okay.
And then each subsequent year after that, it might only be at 1%. So that is something to pay attention into and ask your lender questions if you're considering an ARM product to understand what those adjustment periods look like. Even ask what the index they are using. So it might be something to look into. What they used to use was a common one was like the 1-year LIBOR, where you might want to see what the trends are. Does it go up and down a lot? Does it adjust a lot? So, but yeah, something to look into would be the adjustment period, what that looks like, if there's ceilings, floors that you can pay attention to, and budget for that. If your payment's this now, what could it be in 5 years if it goes up
Could you still
by
afford
1%?
that?
Can you still afford it?
Talking about-
It's hard to really know too, because you don't know what your financial position is going to be in 5 years.
Right.
Could it be better? Yes.
So talking about those trends, I want economics 101. How does the the Federal Reserve, are they the ones that change the interest rate?
They changed so their Fed funding rate is what you've been seeing all the news about as far as the rate increases they've been doing.
Right.
Almost monthly. So it's obviously been going up quite a bit, and they anticipate a couple more increases early next year as well. But those change the Fed funds rate, so like your overnight money that's charged to banks, essentially, to borrow money would be a good way to perhaps put it. But it does increase rates for certain products, but from like the residential lending side and the commercial lending side, those are more based off of like your treasuries, so your 5 years and 10-year U.S. treasuries. So as those adjust up and down, that's where you're going to see your increases and decreases in interest rates.
So from the government to the buyer, how many steps does the money take in order to get from one place to another?
I don't know.
Usually.
I mean, I honestly don't know that. You go from like I could be completely wrong on this, so don't take this to heart. But go from like the Federal Reserve to a bank. It could be as little as I believe maybe 3 steps from getting funds from one to the other. But I could be way off on that.
Well, let me tell you what my
And then to
understanding
the
is.
consumer would be like a 4th step. So
Right. Let me tell you what my understanding of this is, and based on that, you correct me. So my understanding is
and
that
I might be able to correct you because I don't know. Again, I don't know for sure.
so the government lends money to big financial institutions, right? I don't know if you consider, let's say, Wells Fargo, big financial institution. Let's just
I'd consider them pretty big, yeah.
okay. And then Wells Fargo lends out that money to, let's say, credit unions. Will that be the case? And then the credit unions offer those products to.
In a sense, yeah. I mean, it might not be that exact route, but yeah, the Federal Reserve lends money to a large financial institution who then lends money to a bank who then lends that money to the consumer. So, yeah.
So when those rates, so when the government decides to up those prices, those rates, what happens to the money that it's already been, what do you call it, lent?
To the funds that are already lent.
Yeah.
So those rates will remain the
Stay.
same unless they're like on an adjustment, yeah. But otherwise, it's basically the new money that's being borrowed
Okay.
is what's going up. So that's another reason why you might see lenders with higher rates is from a cost of fund standpoint. So if a lender has to borrow money in order to lend money, but the amount or the rate that they're borrowing at is higher than what market rates might be at to lend it at, they might have to charge higher rates, which does affect the consumer. But then again, is basically what the Fed's trying to do. They're trying to slow down inflation, so they're trying to slow down consumer spending. So by raising interest rates, their anticipation is consumers will borrow less and spend less, therefore. So inflation will tamper down. So that's their goal. But it is going to affect
Okay.
possibly affordability from a standpoint if someone wants to buy a house. Well, now rates are 6.5%, whereas 6 months ago they were, or not 6 months ago, but a year ago maybe they were 3.5%. So again, that affordability is getting squeezed, and therefore we're seeing the housing market as well kind of slow down. It's not. I don't see home values decreasing. You're seeing some price adjustments, but that's just normal or natural to happen. But yeah, I mean, it is going to possibly slow down the market as far as what buyers are going to be able to afford, and also if people refinanced into low interest rates, they're not going to want to move. They're going to stay put. So there might be less houses on the market. So that's going to affect supply. So
Which drives prices
which
up.
could drive up prices, because if there's still strong demand, home prices might stay high, which is good if you own a house. Not so good if you're trying to buy a house.
Right. And I can definitely
So-
relate to that.
There's a lot going on right now. Then you have outside things affecting the market as well.
So what are your predictions for the future in regards? And this is, I know it's completely your opinion. You're not stating that's gonna happen, but what are your predictions in regards to the market and rates, interest rates, and lending overall?
I mean, as far as real estate, I mean, real estate's local. You can listen to the national news, and there are some areas that are going to get harder than others. But I think here in the metro, we're going to see a pretty stable market. I don't think we're going to see a huge decrease in home values. If we do, it's going to be very, very minor, probably short-lived. And rates, I feel like they're already somewhat kind of stabilizing. There's a lot of talk of some choppy waters ahead, so we're kind of in uncharted territories as far as not knowing exactly what's going to happen over the next year or two. Might go into a recession, might be a soft landing, as they've been saying. So yeah, as far as rates go, Fed might raise them a couple more times early in this next year, but that might not exactly correlate to higher interest rates, so we'll have to see what happens.
So Union State Bank, what do you guys characterize for?
Your hometown advantage. We're just a small community bank, so yeah, I mean that's kind of what we pride ourselves on. We're not the big Wells Fargo, but we're here to provide the best customer service. We like to know our customers by name and not treat them as a number. So that's what you're going to get, and that's how I treat everyone as well.
Okay. I don't want to say names or especially financial institutions, but um, from conversations that I have with people, there's always this common topic of big financial institutions being terrible at lending products. Why is that?
Um, I don't know. I feel like that might not always be the institution. I mean, like I said, I was with Wells Fargo for a while, and they had some good loan products. Um, the bigger, I would say maybe the bigger the institution gets, the less they might focus on the customer service aspect maybe. So you might feel like you're just a transaction to them. Um, that's that would be maybe my thoughts on that. But I mean, I know plenty of guys that still work at Wells Fargo or Chase or other banks, and they do a wonderful job in my opinion. So I feel like anywhere you go, you could have, possibly one bad interaction, and that's when people are going to talk about it more than anything. You have one bad interaction or one bad experience, you're going to tell 10 people. You have a really good experience, you might tell one.
Right.
So I don't know. It's each lender, each institution is probably going to have its faults, but you just got to weed through them and ask the right questions and find out what's going to work for you.
Is there any financial institution that provides? I was having this discussion with a guy that came with us. His name is Antonio. He works with Ibarra Realty Group.
Okay.
He had this experience working with people that don't have social security.
Okay.
Do you have any insights on that? Have you ever had any experience like that?
Haven't really ran across that recently. A few times when I was working with previous bank, Wells Fargo. Yeah, I mean it depends on the loan products that are being offered, but most banks will require that or a TIN, a tax identification number, and then proper credentials past that, whether it's a work visa or a green card, things like that. Especially your secondary market loans, they're going to be more strict on that than maybe a community lender or a broker. So it's yeah, I've heard that, and it's unfortunate. I wish there were better programs for people that are living here, working here, but hopefully someday.
It's the system.
It is.
Gotta play it, not try
Yeah.
to change it.
Yeah. I hear ya.
Anything else that you think we're missing? I feel like we already provided so much value, and I learned so many things.
First-time homebuyer programs.
Oh,
Maybe?
yes. I do want to talk about that.
Yeah, I know you mentioned earlier. So there's many out there.
What do you need to qualify for a FHA loan?
FHA loan?
That's first.
That's a government loan. I wouldn't necessarily say it's a first-time homebuyer loan. It does offer a low down payment of only 3.5%. But conventional loans you can also get for as little as 3% down now.
How?
Just ask your bank.
How does that happen? Okay. My understanding is that unless you're doing FHA, you can't get 3.5%.
Oh, no, that's changed. Yes, that's actually, I'm glad you brought that up, because that's a common misconception with a lot of first-time home buyers is you don't know what you don't know. So talk to your lender and find out. But you can do a conventional loan with as little as 3% down with most lenders. You can do if you qualify for a VA loan, you can do one for 0 down. So if you're a veteran, active military.
For VA loan, you have to be a veteran, right?
Veteran, active military, reserves.
Okay.
USDA loan, if you're buying in a rural area or a USDA designated area, you can do a loan for 0 down. So if you're buying outside the metro, you may qualify for a USDA loan. If FHA loan's great for, I would say if you can do a conventional loan, 3% down, go that route. In my honest opinion, FHAs should only be used if you have maybe some blemishes on your credit, because they're a little bit more lenient when it comes to credit qualifying, or house hacking. So if you're a real estate investor or want to be a real estate investor or want extra income and you're buying a duplex, anything from a 2, 3, or 4 unit property, and you want that extra income, you can do an FHA loan with as little as 3.5% down.
Okay. I'm interested.
Yes,
I'm sold.
I knew I'd get you on that one.
I'm sold. Okay. Talk to me. What are the requirements for the FHA loan?
You have to be able to prove that you have stable income. You have to meet their credit qualifications. So that's going to differ as well. With the program I work with, it's minimum credit score is 640. Other
640?
banks could be 620. I've seen as low as 600. Be able to prove that you have funds in the bank
Right.
for the down payment and the closing costs associated with it, as well as possibly some reserves. That's really it. I mean, it's when you think about a loan, any loan you try to qualify for in the residential space, it really comes down to like 4 main things: credit. So not just credit score, that gets your foot in the door, but what your credit history looks like. They like to see that you have some credit established and, clean, no blemishes, things like that. Money in the bank, cash for the down payment, closing costs, any reserves if required, stable, qualifying income. So it's got to be income that they can verify, whether it's self-employed, wage. And then the fourth thing is from what you may be able to afford is your debt to income ratio. So they look at what your current monthly debt obligations are, auto loans, personal loans, credit card payments, and anything else that might show up on your credit report essentially, or that you're liable to pay. Plus what the new mortgage payment's going to be. So that principal and interest, taxes, insurance on the house you're buying, and they divide that by your monthly income. They'll usually use gross income if you're a W-2 wage earner, net income if you're self-employed. So after all your expenses, basically what you report to Uncle Sam is what they can use. Sometimes add some things back in, but that's the difference on the incomes. But yeah, the 4 things.
And then
You got to have them all. You can't have just 1 or 2 or 3.
Right.
That's kind of the downfall. You could have
Right.
$100,000 in the bank, but might not have verifiable income, at which point they might not be able to do one of these loans. But you might qualify for another loan product like a portfolio loan with the bank, but then again, you might not be getting the best terms at that point, a higher rate.
How do you go about having a self-employed position, right? And then let's say a real estate agent, but then you just got out of college.
Mm-hmm.
What type of loan products could you apply for?
In that instance,
And let's say that you do have your down payment and
you're probably looking more at some sort of it's going to depend, but yeah, when you go self-employment straight out of college, you don't have like a history of income in that field of work, it's going to be more difficult. That lender might require that you have 2-year history before they can use that income. Or you can find a lender that can do more of a portfolio, like in-house loan or a non-QM type of loan, where they might only require a year or 6 months. They might just, instead of seeing tax returns, they might look at bank statements to see what income flow you have going on. So there's different things that different lenders will do. Conservative lenders that are just doing secondary market loans, they have to use what those investors'
Follow the
underwriting
protocol.
guidelines are. So yeah, if they require 2 years, we'd have to require 2 years. So it's just going to differ.
That makes sense. But that does open a lot of doors for improvement with regards to like going out and reaching out to people, because it's a misconception that you only need 20%.
Yeah.
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 and you don't. But
Yep.
so when you talk about 3.5%, do the terms change?
It's like an FHA loan.
For example.
Yeah. So, I mean, say you're doing an FHA loan, you can still get a 30-year fixed rate or 15-year fixed rate. So it's the interest rates are going to be pretty comparable to other loan products. It's a government-backed loan, so that's where you have your mortgage insurance involved, where you get favorable terms, but you're paying the mortgage insurance, which then insures the backer of that loan in case that borrower ever defaults. So the mortgage insurance might be higher premium. You might be paying more per month for that. FHA, I'm pretty sure it's still life of loan. So with a conventional loan, you might be able to pay your mortgage down to a certain point, that 80% or 78% LTV where it drops off, or you might have home appreciation plus principal pay down where you can get rid of that mortgage insurance sooner. Whereas like an FHA loan, the only way to get rid of it would be to refinance out of it to a conventional loan later on, maybe when you have the equity in the home to do so, or your credit's better where you can qualify for a conventional loan at that time. So yeah, there's different ways to do
How
it.
does house hacking play into borrowing money? Is there any way that you could prove that you're going to house hack and that could help your debt to income ratio?
Well, I'd have to double check on that. With the FHA loan, I haven't done a lot of them lately, to be honest with you. I believe on those loans, and don't quote me on this, you can use the income from those as long as you have a 12-month lease signed and 1 month's rent for a security deposit.
Yeah.
They can use 75%
Of
I
that.
believe it is, of that income to help offset that.
So that could be a
I'll have
possibility
to
for a
double check on that.
duplex.
But yeah.
Interesting.
They may want to see that you have previous landlord history, but I'm pretty sure with FHA you can use it.
Gotcha. That answers a lot of questions.
And that's just a loan product. So a first-time home buyer program would be something that is usually paired with a loan product like your conventional loan or FHA loan. So that could be, for example, Iowa Finance Authority. They have grants available. They have second loans that are only paid back if you sell or refinance. Different options like that. There's Neighborhood Finance Authority that has $10,000 forgivable grants in certain neighborhoods that you can qualify for if you're going to do home improvements. So there's different options out there.
There's plenty of options.
There's good options, yeah.
I guess
That's why people shouldn't be scared. You got to just
go and talk to a lender.
talk to your lender, give them a call, or talk to your realtor. A lot of times they know too what programs or products are offered. They might have a lender that they work with hand in hand and know what they offer. And if that doesn't meet your needs, call another lender. You don't have to marry the lender. Just call around and ask the questions.
Fair enough.
We work for you.
How can people reach out to you?
They can give me a call, 515-273-1256. We'll get you directly to my office. You can go to Union State Bank's website, usbiowa.com, and go to the mortgage page, and there you'll be able to find out some more information. But yeah, give me a call. Shoot me an email. Be happy to keep the conversations going.
What are your favorite loans to service?
I like the commercial side, personally. It's you just get more creative with things. You get to see more. I love working with first-time home buyers and help educating them and starting their journey. But working with real estate investors, I'm just passionate about that. That's where we met, was at real estate investment meetup.
Right.
So
That's right.
it's kind of my wife and I, our side gig is we dabble a little bit in that, and it's just great working with investors as well and kind of opening up their eyes to different ways to structure deals, get loans to work. And
And I'm
they
sure
might not have thought of. So
I'm sure their experience helps the process because you're not telling them, okay, well, a mortgage is this, and
yeah. I mean, it's half and half. You got sometimes first time investors that didn't even know commercial loans existed. They're used to like just conventional financing. So kind of explaining that to them, and the differences and getting them on board with the different terms there. But also, like you said, you can have seasoned investors that have it's not their first rodeo, so they come in and kind of know what to expect as far as what documentation you're going to need and in the process overall. So it's a little less hand holding at that point. But yeah.
yeah. Man, I think that sums it up for the entire podcast. That was very helpful. Like, I have a lot more questions,
Yeah.
like I said, but at least I'm getting to more knowledge every day.
Absolutely.
So, thanks for coming. I really appreciate your input, and I know that the moment something big happens in the market, I'll give you a call and I'll have you here over again.
Heck yeah.
So you can kind of like explain what that means when you want to buy a house, when you want to buy a property, especially on the commercial side that you said that you enjoy so much.
Absolutely.
Yeah. If you made it this far in the podcast, I will really appreciate if you subscribe. We're trying to provide as much value here in Iowa, especially for those who are new to investing or the ones that just want to acquire more knowledge from people that have been doing this for 10 plus years, not including me. But your support is really appreciated. There are more videos coming up, and this just happens to be the most boring one that we're going to give.
Yeah.
But
Telling you, lending, it's getting better though.
no, I'm just kidding. This was really, really, really useful. And I'm sure if I find it useful and you watch this video to this point, you find it useful too. Follow us for more information, and I'll see you next week.